be providing simultaneous translation, English to Spanish, Spanish to English. You can select that option on the bottom part of your Zoom screen. If you have any doubt regarding this option, we will be assisting you at that respect. If you have questions for the speaker during this session, you can write them in the Zoom or YouTube chat. Please do not forget to mention your name and institution once you write the question. Once the session ends, we'll be posting the replay in www.eventos.flor.net.
Welcome back. My name is Antonio Candia and I am a head portfolio manager here at FLAR. I hope everyone is ready for our final session with the collaboration of private institutions. Joining me today from the Central Bank of Chile is the Manager of Financial Market Analysis, Juan Carlos Piantini. As a central banker, Juan Carlos has a long career and vast experience, mainly dealing with sovereign wealth funds, international reserves, and investment strategies. But also as an academic, he contributes to several universities by giving lectures on economics and finance. Thank you very much, Juan Carlos, for accepting our invitation to moderate this session entitled A Risk Balance Sheet Approach to Navigating Market Shocks. Our virtual stage now is yours.
Good morning, good evening to everyone. Thank you, Antonio, for your kind introduction. And thank you very much, Igor, for the invitation to host this session today, and to FLAR's teams for organizing this annual conference. It's a pleasure for me to be here today and to have the chance to speak to central banks, sovereign wealth funds, and other official institutions. We've known each other for many years, and this is a great opportunity to get together again, virtually, I must say. We've had very interesting speakers during the week, and today we have the great opportunity to talk to Mr. Robert Merton, and I feel very much honored for that. Our conversation will be divided in three parts. We'll begin with Professor's remarks. Then we are going to have time to talk about some key ideas from his presentation, and we are going to end with some questions from people from the audience. Before we begin, let me share with you some key points of Professor Merton's career. He received a Bachelor of Science in Engineering Mathematics from Columbia University, a Master of Science from Caltech, and his doctorate in economics from MIT in 1970, under the guidance of Professor Paul Samuelson. He is Distinguished Professor of Finance at the MIT, University Professor Emeritus at Harvard University, and Nobel Laureate in Economic Sciences in 1997. He is resident scientist at Dimensional Fund Advisors. By developing and applying high-power mathematical tools, Professor Merton has influenced academics and practitioners in many fields, including investing, risk management, retirement planning, financial regulation, and, of course, derivative securities. Today, Professor Merton will share with us some ideas on how to think about the sovereign balance sheet, and also he's going to be talking about risk in the context of an unified microfinance framework. Professor Merton, you are very welcome today, and we are looking forward to your presentation. The stage is all yours.
Thank you. Okay, well, I've got my slides up. Thank you. Thank you for that kind introduction. I'm delighted to be with you this morning. And as mentioned, I'm going to try to employ what I call a risk balance sheet tool and show how we can use this to more effectively both manage and measure risk and improve performance. Now, since it's mentioned in the introduction, we're talking about asset management. We have various funds here. So I'm going to start first by talking about, within the context particularly of market shocks, a tool to employ for strategic asset management. And that tool is called the risk balance sheet. Now, because of the audience, the original asset management, as we all know, was just looking at assets. Then I think led by the managers of pension and retirement funds, we moved to the idea that, we ought to look at what commitments or liabilities or what we're trying to do with the fund in order to help us decide what investments to make in the assets. And that became what we've come to know as asset liability management. You look at your liabilities and use those as references to design the right strategy to optimize fulfilling those commitments. And that was a very big step forward. What I want to show you this morning is the next step, what I might call a integrated strategic asset management. And I'll work from the analogy of the tool of doing a retirement fund or pension fund, would apply, as we'll see in a minute, to any kind of fund management. But if you think about, let's say, a traditional pension plan and a government one, yes, the pension fund is dedicated to meeting those obligations. But if you just optimize the pension fund as if it's the only source for that, you're going to get a distorted result. And the reason is there's two sources that are providing those benefits. The pension fund, but in the event the pension fund does not have adequate assets to fulfill the obligations, then you have the sponsor, in this case the government, guarantees those payments. So you really have two sources. Now, everybody knows from Portfolio Theory 101 that if you optimize a subset of your portfolio, but not take account of all the assets, there's no reason that will get you close to an optimum. That's quite clear. So what I want to introduce here through what I call the risk balance sheet, I'm having trouble moving my screen. I don't know what's going on here. Can someone, this is just, can someone put my slides in there? I don't know. I have to try to.
That's perfect.
I don't know what's going on here. Do you have my slides?
We can see the second slide, yes.
That's okay. I don't know why. I apologize to you. Here's the risk balance sheet. I do it for the government because the government is the other source. And this applies to all of the commitments of the government. And what I've listed here is a balance sheet. Is the left side are all the assets of the government. It's a balance sheet. So these aren't flows. These are the capitalized values or present values in the case of flows, or the asset values themselves. On the right side, I put all the various liabilities and then the uncommitted part. Now, if you look on the left side, you'll see under funds, I have three different kinds. The pension fund is committed on the right side, the lower part, to the pension liabilities. And that's true. But as you can see, the rest of the assets of the government are also committed to those pension liabilities as well as its other liabilities. So therefore, to do the right kind of optimization, you want to take account of in what you do in the pension fund or the sovereign wealth fund, the stabilization fund, reserves, you want to take account of what else is the government holding. So let me give you some concrete examples. Let's go up to the top line on assets, taxes, big factor. Now, this doesn't only measure the size of the assets, but we use it to think of the risk. If you have a country, for example, for which copper is a very big component of the economy, then taxes are going to be sensitive to copper. If it's an economy which has a very large component of energy, oil and gas, same thing. Therefore, in effect, when you look at the balance sheet, you already have an exposure, in one case to copper, in the other case to oil or gas. So in your pension fund, even if you're trying to run a sort of well-diversified portfolio, if you hold the same amount of energy or copper as a country that doesn't have those, you're going to be overweighted, not by choosing to, but by not recognizing that you have other assets committed to the objectives. And so each fund should not, we're not too much centralize one thing, we're simply saying centralize information. The pension fund in this example should take account of the fact of these other assets. Same with state-owned enterprises down the page, royalty, if you have very large assets in those classes. So the idea is you look at the total risk properties of all the assets, and then you optimize on your portion of that, taking account of that. So again, if you have energy assets in the country through either through taxes or government-owned enterprises or royalties, then you ought to be not you unless you want to overweight. You don't want to be investing in that in the pension fund or in your sovereign wealth fund. Now, that seems very straightforward, but it gives it it's a very important component because otherwise you get overweighting. Now, let me go to the point out two characteristics of using the risk balance sheet. It's a wonderful communication tool, I found, because if you have to communicate as the head of a fund with your client, I put that in quotes, the government, you can sit and talk to them and explain to them why you are not in this or that, not because of particular things. And you can also explain how you should be measured for performance afterwards. So, for example, if you have a sovereign wealth fund and you don't have any energy in it because it's otherwise covered in the government, other assets, then if it turns out energy outperforms, does well, you're going to not look as good as sovereign wealth funds that don't have energy in the government, and therefore they're holding oil and gas in there, and vice versa. So the point being, you need to work with this, and this is the tool to do it, to explain that in advance, the reason you should be compared is not to, let's say, world, but world X energy or world X these. And I found that, sometimes, particularly during the most recent crisis, COVID crisis, we found a variety of funds have been called upon to do things by the government that they weren't designed to do or hadn't been part of their commitment or part of their message. And this is a way in which you can show the feedbacks and impacts all across. So you can see that if you change things, and on one side you have effect on asset liabilities and vice versa. If liabilities change, you get shocks. It all feeds back, and you can see the system. It's a way of looking at it in a systematic and control. So, and this can be applied at any level. We've done it here for our country because of this audience. If you were in a state or a province and that was your government, that's what you do. If you were a private sector corporation, then you would use that. So the risk balance sheet can be used everywhere. But the key here over other balance sheets is, one, these are market values, but they're also got the actual risk in there, because to make portfolio decisions, you have to be able to make decisions about variances, covariances, and so forth. So you actually have to understand the risk properties across them. So bottom line on this is that we see this as a tool for you to improve performance for the ultimate client and the objectives, and it's a very good communication tool. So now I want to step to the next topic, if you change the slide, which is dealing with the unified approach to macro financial risk or policies. I have the three big policies here: monetary policy, fiscal and debt policy, and stability. Now, this chart, which is a characterization, of course, is in my view, a traditional flow and accounting framework for looking at these policies together. They're sitting there, you have what they do. On the left side, you have the households and corporate accounting balance sheets and so forth, and you have the flows in through there. You have interest rate policy, the central bank, and then on the other side, down below, you have government accounts that flows out into the markets. What's missing here is there are no risk adjustments in the balance sheet. In effect, this characterization acts as if there's no uncertainty, and there's no credit risk. And because there's no uncertainty, the guarantees don't mean anything. Insurance or guarantees have no meaning in a context of a certainty world. And so there are none of the risk exposures are there at all. So now if you, to take account of that, I want to use the risk balance sheet. So if you'd move to the next slide, please. Okay, now you see, this is a more complicated slide. Just flip back for a second to the previous slide. Now back to the slide. You see, okay, so you see a lot of things have filled in. The difference is here, we now use risk balance sheets, which not only put the accounting numbers, but market numbers, but they also put in the risk characteristics, as I exemplified before. You also see now that you have risk flows going and things between the financial system, the credit risk is going back and forth. You see you have liquidity risk exposures going back and forth between the financial sector. On the other side, you have the sovereign risk characteristics indicators and sovereign debt and all that. And now, in addition to having interest rates, as you go down the page, you see guarantees. And guarantees are a really big deal, as I think we all know. And guarantees are embedded in just about everywhere. And so by looking at this, you can see the interactions that take importantly in risk. So we can build explicit models that are structurally, I don't mean by Monte Carlo simulate, structurally have the risk in it. So they pick up the features of risk flows that a model built basically on a certainty structure can't do. And to illustrate that, let's go to the next slide. Okay, I just want to point out something about debt that you may know. If I had in this hand some piece of debt that has credit risk, could be anything, and in this hand, a full faith and credit guarantee of the government, the sum of those stapled together is risk-free. So if I take away the guarantee, risky debt, that has credit risk, is the same as risk-free debt minus a guarantee. So I point out two things. Every time you buy risky debt, you're doing two kinds of investing. You're investing money, risk-free, time value of money, but you're writing guarantees. That's insurance. A guarantee is insurance. When I guarantee a value, I'm writing insurance. Honorable thing to be doing, but recognize that's what you do every time you buy debt. Now, what's the character of the guarantee? I have it here on the slides. By the way, these slides will be available to anyone who wants them. You don't have to take notes or anything. If you look at that, think about very quickly, when does the guarantee come in? Guarantee comes in when the borrower can't pay what's promised. So if we think of it as the borrower has a market value of assets of A and it's promised B, and A is less than B, can't pay, then what's the value of the guarantee? In that condition, the value of the guarantee is you get paid the full promised amount minus what you would have gotten by liquidating the assets. So on the other hand, if it has enough to pay, the guarantee, like auto insurance, expires worthless. If you look at that payoff, you see the guarantee is structurally the maximum of zero, the promised payment, a fixed number, minus the value of the assets. That's the structure of a put option. So my main point is that guarantees are put options. They are the same things. And from that, we can now use that to more explicitly show you what are the important risks that are picked up by looking at the interaction of risk in the balance sheet. So if you'll go to the next slide, please. Okay. Now, what I have at the top of the page is a static picture of the value of the debt of, it could be a corporate sector or household sector, housing, okay, versus the value of the assets that are behind that debt. And as the larger the amount of assets, of course, the debt's worth more. Now, suppose we're at initially at A sub C, the higher point, and there's a shock or a series of drops so that the asset value of behind the debt falls to AC prime, to the left. Now, looking at the picture, the first thing you see, of course, is the value of the debt or the loan goes down. That's not surprising. But what I want you to see from this picture, which is insidious, when you go to the original point, the first point on the top line, if you do a sensitivity analysis and ask the question, what if the underlying assets went up a little bit or down a little bit? How much would it affect the debt? We see it's pretty flat. So asset changes don't have much impact on the value of the debt. The debt's not very risky. But when you fall to the new level, not only does the debt have a lower market value, but for the next roll of the dice, for the same move in assets, you get a much bigger effect. You see the line is steeper on the left, the tangent line. That means for the same movement in assets on the second shock, you get a bigger hit on debt. That is that nonlinearity, that concavity, convexity, is what makes credit risk and these kinds of shocks very insidious, because we say it's the same debt, it went down in value, okay. But it's worse than that because the next roll of the dice actually changed the risk. The risk is not constant. The risk changes endogenously. It will happen every time. This is a fundamental from the structure. Now, that's what happens in the case of the thing. Now, let's look at the banking sector that is holding those mortgages or that debt. Well, they've written a put option. Their liability is the lower left side. We see that if the assets that they are essentially guaranteeing corporate and household, as those assets fall in value, their guarantee goes up. That means their liability is larger. So the debt value or capital of the banking system is smaller. But again, I want to underscore, look at the difference. Where you started on the lower right, you had, for a small change, the sensitivity had a certain slope. So as you have variation in assets, how much does it impact the guarantees embedded in the bank loans? And it's one level. But when things have fallen, as I explained in the top picture, you see that, in fact, the next roll, it'll be a bigger risk. And if you have a third shock and you move to the left, as we have had happen during the big crisis, you can have the risk of the guarantees along with their value change goes up and up and up, even if you don't change a single position in the bank. It's this nonlinearity that is so insidious, where typically if you use regressions, which inherently are assuming that these elasticities are constant, they're not. In fact, they're entirely predictable. When you do a risk balance sheet where you include these guarantees and so forth, the model itself will automatically pick up this convexity concavity, and therefore you will have feedback immediately as to what's going on. Last point I want to make on this slide is the following. Look at the lower two, the banking sector and its guarantees, and the government. Both are liabilities. Let's say the banking sector gets a shock, and so it's the asset supporting it falls. Then the guarantees it's written, have gone up. Okay, but now what happens? Because the government has guaranteed the banks, it also gets a shock because now its guarantee of the banks has gone up and it's become riskier. So you have lower capital and more risk. That's what you want to see. That's the big story that you need. It's not constant risk, but just lower amount of capital. Risk actually goes up. And if you did 2 or 3 of these, you can see that the friction can go up dramatically. All right, now let me tell you about feedback. What if banks are asked to buy the sovereign's debt? Not uncommon. Well, we saw from my previous chart, when you buy the debt, you're writing a guarantee. So when the banks buy government debt, they're guaranteeing the government. That's not a matter of opinion, that's a matter of structure. Now let's look at what happens with feedback. Let's say the banks get into trouble, they get a shock, so they get weaker. As a result of that, the government's liability, the guarantee goes up, its liability goes up, it gets weaker. But when the government gets weaker, that feeds back to the banks that their asset, that they've guaranteed, remember, they've guaranteed the government through holding the bonds, has gone up. And so you get into a really bad situation of feedback where it spirals one into the other. You can say, well, who would ever have a system like that? We do this all the time. We all the time have institutions guarantee an institution and then have the institution that are being guaranteed by the guarantor. And so this is how you can get really insidious feedback. All of this is picked up if you have a risk balance sheet approach and use those in there. Finally, I just want to show it, and then I'll stop on this note if you'll come to the next slide, please. What I just showed you with feedback between the government and the bank and their sovereign, the sovereign and the banks, that was just in one country or one jurisdiction. But of course, as this picture here is designed to show, often you have banks in one country buying the debt of a sovereign of another country. In their case, what happens? You have the sovereign, let's talk about it hypothetically, not hypothetically, Euroland. A German bank buys Greek debt. The German government is guaranteed the Greek banks. But the German banks have guaranteed by buying the debt of Greece. So therefore, the German government is ending up being, essentially guaranteeing indirectly Greece. I'm not picking on those countries, but these are just familiar situations from the last crisis. So what this picture is showing is that you get really these feedback loops across geopolitical borders. And they come from both explicit and implicit guarantees. And as you can see, the whole picture, I don't want you to try to go through all the paths. What I want you to see from the picture is the message. it gets very complicated how the risk flows go. And therefore, it gets very complicated to understand who's exposed to what, and therefore what kind of policy actions to take. Finally, I'll say, and then I'll turn back to our moderator, that I want to say that sometimes one policy has material effect on another policy. So, for example, if monetary policy does qualitative easing to bring let's say long rates down to stimulate investment, housing, consumption, that's great. But what is one of the implications of that? For someone of my age, I'm actually poor. Why? Because I'm thinking of retiring. Even if my assets have the same value as they had now, those assets will only earn me a much smaller interest rate. I'll have a much slower retirement income. I feel poorer. I either have to save more or live worse. So what was good for one, it's actually a very bad effect on me, and I'm going to behave as such. But even more from a stability point of view, what about the institutions? When we drive, you go back, if we went back, I'm not asking you to, we went back to the risk balance sheet, what do we see? When you drive interest rate down, you drive pension liabilities up because the discounted value of those fixed promises, because remember, they are guaranteed, okay, goes up. So you increase those liabilities. And in fact, if I'm an insurance company writing annuities or a pension fund, I could well go insolvent because my liabilities went up. Now, if you couple that with also the asset guide going down, like a stock market decline, as we observed, let's say 2008, 2009, so forth, then you can see this puts a big risk shock on the system. So a monetary policy designed for stimulus or can have a stabilization impact, an unintended consequence. And these flows across, it's not that you're centralizing it, but you need to have some sort of collaborative understandings of what's going on to be able to have the information to make the right decisions or at least the right judgments. So with that, I'll turn it back to our host.
Excellent. Thank you very much for your presentation. I think it was very interesting to understand in a more comprehensive way the concept of risk connection among different sectors of the economy. Also, it's very interesting to see how the traditional framework is a particular case of the unified macrofinancial policy framework, where in the first case, asset volatility is set to zero, right? And of course, this makes a lot of difference. We are going to be talking about that in a minute, but before we start our conversation, let me remind the audience to keep questions coming for us to answer in the last part of the session. So, Professor, let me begin with the first question. As you showed us, the influence of one sector on another in terms of their credit risk is core to the framework. The degree of connectedness with respect to credit risk does change through time as economic conditions evolve. Your research creates a heat map to represent the number, direction, and intensity of all risk connections among different sectors. Can you explain how the connectedness is measured and how is it represented in your heat map to identify in those changes precursors for systematic risk events?
Thank you. Well, let me just quickly give you an outline of what we do. We use what I've shown you already, which is what we're interested in is we're completely focused in this example that you've given on the connectedness among financial institutions, banks, insurance companies, each other and across them, but also with sovereigns. And so what we want to know is what is the sensitivity or credit risk connectedness between them? And we measure that. The models that measured, I'm giving you the simple version, but that's fine, that'll do good enough. The simple idea is we take things like the measure of the credit, the cost of the guarantees, right? Which is a measure of credit risk, right? A CDS contract, of course, we all know is what you pay for CDS contract is the cost of the insurance. The higher the price, the more the risk. So what we do is we take the value of guarantees of banks, and insurance companies, and sovereigns. For sovereigns, we do use CDS because we want to use market prices, because I'll explain in an instant why. But we use CDS to measure the current credit risk of that institution. We then look at, and for banks and insurance companies, we don't. We use a model like the one that we have that's been used in practice for 30, 40 years. So it's quite good enough for this purpose. We use a model which is driven with inputs by market prices for stocks and other traded securities of banks and insurance companies. The reason we do that differently is we're interested not just in the risk of the private sector is bearing with the institutions. We want all the risk. CDS of a bank only measures the private sector risk of the bank. The bank may be very risky in terms of assets, but if the government's guaranteed it from the private sector's point of view, it's risk-free. So we use two different, I don't want to get too much detail, but so now we have a measure of the risk at any point in time, the cost of risk. Now, what we do is we then relate that across institutions. So a bank with an insurance company, we look at the relationship between the risk of a bank today with another bank tomorrow. So we do a kind of distributed lag drivers to identify sort of Granger causal relations, where if the credit risk of one institution changes, how does it impact another institution? And that's how we measure it. Then we do that for all of them. And we only look at the significant ones because, a lot of times there's just not that much connection. I'm going to show you some pictures. So I just want to tell you what's behind it. So we measure that, and that degree of sensitivity is a measure of how connected they are at risk. If they have a very high R squared, if you like, a very high correlation, then they're very highly connected on risk, credit risk. All right. And you could do it back and forth. You could, you could do one institution to the other, sovereign to sovereign, all those. We do them all. Okay. And then we take those plots and then we create a visual of, as you say, a heat map in which we map the connections and graph them. And we do, as a lot of times you've all seen, we put the ones that are the most important in the sense of biggest weight with so many together in the map. So you see things put together in groups so you can visually see what's going on. And we use colors. And if you look at it carefully, you'll even have arrows. So sovereign A affects bank B going one direction. Bank B affects sovereign A, that would be an arrow in the other direction. If both interact, as I showed you in the previous example, then the arrows go both ways. So that's what you're seeing. Now, what does this map look like at a point in time? If you could put my slide back up, if somebody could put, I apologize, I don't know why it wasn't working, but it wouldn't move. If you put my slide back up, go to the next point. Next slide. Next one. Okay, this is a picture of, it looks like a Google map from Mars or something, but this is a picture of imagine leaving a camera open for 3 years. So it's a composite exposure. So one picture is showing sort of the average connectives over the pre-crisis period up to 2007. And the red around the borders in red are the bank's names, in blue are the insurance companies, and black are the sovereigns. And what I want you to see from those are all the only statistically significant, important connections. So not every connection, and only with respect to credit risk. And you see how they run from all the different institutions, sovereigns, each other. Blue is insurance, red is banks, and black is sovereigns. Okay, so does everybody understand? This is showing you the connectivity, the colors tell you, and if we were to zoom in on it the way you can with Google down to look at things, you could see each one of those spots, which sovereign and which banks are connected. But all I want to do at this point, so we kind of get on, is to get it across. Go to the next slide, please. Same thing, but now we're doing it for 209 to 212. Flip back, please. Go forward. You see visually a big difference? That's what you're picking up. What we're getting here is, is not only the intensity, but all the connections as these things. So this is a visual to show you that risk connectivity changes dynamically quite a bit. and particularly different in those times. And so there's really a meaningful reason to be running these things often. And the beauty of using market prices to drive these asset prices is market prices first react very quickly to information, not always correctly, but they react to information. So they're not stale. And they represent a composite of sort, right? The market composite of what cleared the market in active markets. And they give you information that you don't get from accounting balance sheets or what you get from positions. Just looking at positions of an institution doesn't tell you this sort of thing. But what you can do from this is get through the model, you can keep updating, and you can even identify, I just mentioned as a throw off, endogenous stress tests by seeing entities that look like they're highly connected. And you just like to say, well, they appear to be highly connected, at least according to this. Why are they highly connected? And should we stress what the impact of that higher connectivity is? I'm just trying to give you a feel for how this tool can be used, but to also have you see that the dynamic of change is not slow. By quarter to quarter and so forth, you can, depending on the times, and you can run this thing once it's all set up as much as you like. I mean, all you have to do is have market value feed-ins. So it's not like you have to wait for a balance sheet to come in or anything. You can run them all the time. This is not to replace what's being done. This is an addition for you to get a sense of the degree. Now, connectivity, I should mention, isn't by itself bad. It's not, we shouldn't have connectivity. It's simply telling us that if you have a high degree of connectivity on credit risk, you are susceptible to potentially a systemic event driven by the kind of thing I showed you before. And so it's a kind of, giving you a sense of the conditions, not, I don't want to make it sound like connectivity is bad. We should pass policies to get rid of connectivity. This is how we do things, and this is the way things work. So I hope that gives you some answer to that one.
Sure, thank you, Professor. And precisely in relation to that, risk connection between different sectors is not necessarily bad, as you mentioned. It tells us that it might be a potential vulnerability. At the same time, risk connectedness is dynamic, so it's evolving all the time. So, Professor, considering your experience with investors, regulators, and official institutions, are we prepared to integrate this framework in our day-to-day duties? What needs to be done from our side?
Well, I mean, as you introduced me, I'm a theorist. I mean, I've evolved a lot, obviously, designing things and so forth. I think the concepts are good ones. I think they're ones that need to be tested more to see how they do. But I think these are very solid. We've been doing stuff like this in other contexts for 40 years. So this is not in that sense that radical. But applying it in this way, it did. And it's going to take effort, one, to build the models, to calibrate them, and to be able to understand them and to use them. And again, I want to underscore, these are not to replace what was done now, but as I think a useful adjunct. So I do believe we have the technology, the data, we have the things that are needed. And, but I would be, it's easy for me to sit up here sitting on the Charles River to tell those in capitals around the world and central banks, okay, just throw this in there, it'll be fine. And I know how much it takes, but I hope this gives you sort of some, I hope it stimulates your thoughts that, with big data and everything, which we can also use, although this isn't really very big data, actually, you can do quite a lot along these lines. And again, I just want to underscore that the risk balance sheet is a very, very versatile tool. You can use it for personal wealth management. I mean, you can have the risk balance sheet for a family, and you can apply it. You can have it for an institution. You can have it for a corporation, or as we saw, you can have it for a country. So the concept can be used always, but the key is to understand the risk flows as much as the capital flows or other things that you measure or changes of that sort. And I would just close on that point to emphasize it. Think of an option, an option, doesn't matter what model you use, okay? The value of that option depends on the asset value, the value of the asset that you're insuring or guaranteeing. but it depends on other things. So even if the asset value stays the same, the asset was worth 100, it's still worth 100. But if the volatility of that value, the dynamics, which you don't see directly in the flow, in the balance sheet, the volatility change will change the value of that guarantee and will change the risk of that guarantee because you saw the slopes, everything's nonlinear. So what I wanted you to see, the richness that you get this is that you pick up dimensions that impact risk in a material way, both as well as value, but also in terms of sensitivity, or if you like, exposure, by using a risk balance sheet. And I find it a very useful tool.
Definitely. Excellent, Professor. Now, let me go back in time, because back in the 70s, Eugene Fama showed us the power of diversification, right? So the basic idea behind it was, while you increase the number of assets in a portfolio, the overall risk is reduced to a point where you are exposed to systematic risk. My question is it possible to extend this idea to other ways to manage portfolio risk and thereby expand the risk reduction potential and at the same time improve performance that we might get if we manage risk properly?
Absolutely. And again, I have a set of slides that I'd like to make reference to. If you could go back to them, I'll explain. If you could get them up again. Thank you. Now go to the next slide, please. Okay. First statement is there are only three ways to manage risk. Diversification, which you talked about, and that's, everybody knows that. So let's say that. But there's also two other ways, hedging and insurance. Now, to show you how those are different and how they combine, I have a graph here. On the right, on the x-axis, the abscissa, we have the best diversified portfolio. So we already have the best diversified portfolio. If we just use diversification, we get the 45-degree line as our payoff to our portfolio. If we decide that that's too risky for us, which most institutions, very few institutions put 100% in risky assets, then we can hedge some of that risk by selling off some of that risky asset and replacing it with a risk-free asset. That's hedging. You give up the upside and the downside. That's the orange line. Notice now, even if the asset went to zero, the risky asset went to zero, you have a positive amount. But because you only have a fraction of your portfolio in the risky asset, as the risky asset goes up, you get a flatter slope. That's the orange line. Now, there's a third way. You could also insure, you could hold the risky portfolio, but take some of that portfolio value, okay, and buy a put option, buy insurance on it, buy a guarantee. So you see you have the same floor that you have with holding bonds, say a 60-40, 40% in risk-free assets, okay? But because the insurance costs a lot less than 40%, all right, you can put a larger percent of your total portfolio in the risky asset. So you get the blue line. It's not a straight line, it's a flat line and then an upper thing. So that looks like a call option, but the point is it's a floor with upside. Now, that's insurance. Buying calls and buying puts is buying insurance, writing calls or writing puts is writing insurance, both honorable activities. But what I want you to see from this picture before I complete my answer to your question is that none of them dominates the other. That there are places in that outcome where 100% in the risky asset is pretty bad, as you can see. There are places in the portfolio where hedging some of it would have been best. And then there are places where insurance are best. Yes, you pay for insurance premium, so you, of course, are going to be behind someone who doesn't insure. On the other hand, if you're competing with someone who is managing risk by only putting a fraction in the risky asset, you see if things go well, the blue line will outperform the orange line. So my message to you, three ways, none dominate them, and these are the three tools we have to manage all of investments. And I would say, as my observation, and those in the audience can either verify or question, that big institutions, okay, by that I mean with big asset size and so forth, rarely use insurance other than they sell some insurance when they buy risky bonds. But they use diversification and hedging. They don't use the blue line. And my point that I wanted to make with you, from your question that I always like to bring up when you get a question like that, is that you're the most sophisticated institutions in the world. You face big challenges. You got to use the whole field. You should use all the tools. It doesn't make any sense to use only 2 of the 3 tools. And I'll give you an example of showing you how you could use insurance to actually improve your outcomes depending on what your goal or commitments or liabilities are. But that's my story. And I actually believe that we will see more and more insurance being a systematic part of investing, but that's a longer story. To show you how you can improve performance as well as manage risk, if you go to one more slide, please. All right, I mentioned an underutilized tool. So I'm showing you here, let's say we have our best diversified portfolio, optimal combination of risky assets, all the alphas, everything we can possibly do. And we have those, and that's that portfolio, that's the best diversified portfolio. Now we have on the left side a very common situation of where insurance is used, where, as you saw in the previous slide, you have a floor minimum, you buy insurance, and then you have the upside, so floor upside. Because you have to pay for insurance, you don't pay for hedging, you don't pay for diversification, but you have to pay for insurance. The payoff is along the green line, is below the 45-degree line, which is what you get if you don't insure at all. You don't manage the risk. Okay, and that's a pretty familiar strategy. But now what I want to show you is, suppose that I'll use a pension fund because it's concrete, a retirement fund. Suppose you know that fully funded, that if you had 190, and you can put as many zeros in the chart as you like, if you have 190, you're 100% funded. You've met all your liabilities. Well, having more than that would be nice, but that's not your goal. That's not the purpose of the fund. And for me, the objective when you're managing a portfolio for best performance is to have the highest chance of getting to success, beating your goal. And if you fall short, you minimize the loss that you have when you have shortfall. And let me show you how, using on the left as the benchmark, we bought insurance. What we do on the right side say, look, we don't need the payoffs above the goal, 190. So we sell them off. How can we sell them off? Well, we can sell a call with a strike price at that 190. It's call as insurance. So you get paid for the call. You now take the premium of the call and you invest it in your portfolio to try to get to the goal. Because you have more to invest than on the left side, where you bought the insurance with the put, you now have if you look at the picture, you can see every point for the same outcome. Remember, the x-axis is the same risky portfolio. So the outcomes are identical in terms of the portfolio. But look at the outcome to the investor. If you do the second one, you give up the upside, but notice for every outcome, you'll have a smaller shortfall. So take any point, beyond the flat line, and you'll see that first the flat line starts going up at 95, where on the left it only goes up at 100. So you start going up beyond that minimum. At every point, pick any point between 0 and 190 and compare them. You'll see the right side has a bigger payoff, smaller shortfall. You also see that on the left side, you'd have to get to 200 in your portfolio to meet your goal. On the right side, you only have to get to 190. So what can I say without any probability distribution assessment? The probability of getting to your goal on the right side is higher than on the left, because you got to get to 190 before you get to 200. That's the common sense. So summary, by selling off that which you don't need for your goal, you are able to both increase the probability of success of getting to your goal, and if you miss, have a smaller shortfall. That sounds to me like superior performance. And so I'm trying to demonstrate to you that insurance can be used to improve and tailor to the objectives that we were working out. Remember all the way back to my first slide, what are the purposes for the fund? What's its, what are its what commitments they're trying to meet? And finally, I would say from this about insurance is the right side is likely to be the more common case. You buy insurance on that which really matters, and you sell insurance on things that you don't need. And so a typical strategy employing insurance will involve both writing and buying insurance. And so it isn't that you're always insuring if you're risk averse and so forth. You do both. So I hope this, at least if you haven't thought that this framework, stimulates you to think about opportunities to improve in both performance as well as the management of risk by using all three tools, including insurance.
Definitely, Professor. Thank you very much for that answer. It has been a very interesting conversation so far, and time is flying. So now I think it's time to take some questions from the audience. Let me start with the first one. Let me see if I can read it from here. So the question is, going back to your asset liability management approach, one issue that worries me is pension liabilities. Aging population increases our liabilities faster than our assets given extremely low levels of interest rates. How can we solve this problem without adding more debt into the equation or increasing the risk pension investments?
Well, I wish I had the magic wand to do that, but let me just start with a statement. If you want something done risk-free, so if you don't increase risk, let me be concrete to your question. Let's say you're currently holding a risk-free position, but the interest rate's too low for you. Well, I have no way, if the risk-free interest rate is 1%, I have no way to provide a 2% return risk-free. If I did, who would buy the bonds of the government for 1%? And yet, of course, we all do. So the first thing I have to say is we have to accept the fact that the risk-free rate is what it is at a point in time. It's like the weather or anything else. We don't control it. Maybe the central bank does on the policy side, but we as investors don't, and you as asset managers don't control the environment. And so the first thing that one has to recognize is the only way is to take more risk. The question is, how do you take that risk, and how do you manage it in the best way, and how much more should you take? First, should you? The answer is, why do we take risk? We take risk in our portfolios because we're trying to achieve a goal. In your case, your example, pension liabilities. We're trying to be able to pay them with the fund. And so we say we can't get there with the interest rates very low. Maybe we couldn't get there anyway, but we couldn't get there with interest rates as low as they are. So we say we take risk prudently because we try to get somewhere we can't get risk-free. Now, with that as a framework, now I can show you, we're not going to go through all of these things. I'm saying now we start out and we say, should we take the risk by taking some credit risk, or should we take the risk by increasing just our allocation to, stocks? I mean, there are many, many ways to answer the question. And the way I would do it with the risk management, and the liabilities, is to look at the whole piece. But I'll come back to my opening remark. The pension fund is not the only source. In a strict sense, okay, if you knew the government could always pay and would, then actually the pension fund, while it's collateral for the pension liabilities, it's really an asset of the government. If the pension fund does well, the government has to pay less out of the rest of its assets to meet the liabilities. If it does poorly, it's going to have to pay more. So it's always important to understand that while the goal is to get people their retirement payments, that it's the government who, if it's guaranteed them, that's going to eat, is actually taking the risk, and other asset holders. And that's important to remember. Who's taking the risk? So finally, I would just say on that you can use the risk balance sheet still another way, which is not very pleasant. Some pension liabilities in my country, in our states, are really debt. The government can't say, I can't pay that much, so we're going to change it. Social Security in my country, so Congress decides what benefits are. So of course, one solution is to change the liabilities, reduce benefits. I'm not saying it's a good solution, but you can see that on the risk balance sheet. So I'm not saying, what I'm trying to tell you about the tool, it allows you to answer your question by using the tool to review all the possibilities, even though you certainly don't want to do any one of them. So, I think this will help you by focusing on the goal. I've tried to show you in this slide you're still seeing that if you focus on the goal without having any higher alphas or higher Sharpe ratios, that's all jargon, but in other words, without really being able to improve performance in the usual way it's measured, you see that you can improve your chances to getting to funding liabilities by using a more goal-based, structured approach to investing that's focused on the goal and not a generic, 60-40, whatever kind of strategy. That's all I have to offer. There is no magic. Anyone who tells you they can earn 3% risk-free when the government is 1%, whatever is true, that isn't. It's like the magician. I may not know how the magician did the trick, but I know it's a trick. It isn't for real.
It makes a lot of sense, Professor. We have 1 or 2 minutes left, so maybe the last quick question. Considering the idea of the adverse feedback loop that you referred to in your presentation, in your opinion, have we learned enough from previous crises? Are we better prepared today from a risk management perspective?
I'd like to believe we have learned things. We also have more tools. We have more markets. We have better information from markets as well as other sources. That's the good side. We've had regulatory changes. That's not my bailiwick. So I'm sure you've had people talk about that maybe. But I think we have. But where I think we make a mistake too often is we drive. It's like driving a car looking in the rearview mirror. When I drive down the turnpike, the Autobahn, I sometimes drive pretty fast. I don't tell anybody. And so when I'm driving, I'm kind of looking in the rearview mirror to see if there's someone going to slow me down, pull me over. So I'm driving it, I don't know, 30 meters a second, whatever, looking in the rearview mirror. Now, if what's in front of me on the road is the same as what's behind me, that works, right? Looking in the mirror. But if there's a change in front of me, that's a disaster. That's my metaphor to say the thing we have to be diligent about, and I hope some of the things I showed you this morning, is not to look just at the past, what did we learn from the past. That, of course, goes without saying we should do. But we should recognize that the next crisis is not going to be just out of the past. And if we keep trying to address the past without doing the analysis using theory and empirical work and things that haven't been done, things that haven't been experienced, to anticipate what could happen, not what has happened, I think that's a very big and important objective. And I'm not saying that people don't do this. The question is, how much is it done and with what degree of resources? But that's the one thing I have to say on that is that the world changes. Some things repeat, but enough changes every time that the next crisis will not really be the same as the last one. When we always are saying things like people never learn, they keep making the same mistake. I think it's like so many things. If you look at it broad brush, it looks like they're repeating. If you look at it a little more detail, you discover there are enough differences that this time the way we messed up was different from last time, and it'll be different next time. So please let us use our resources, our theories, our empirical work, our experience to examine that which can happen, not necessarily just what has happened.
Excellent. Thank you for that. I think our time is coming to an end. It has been a very interesting session. In my opinion, one of the takeaways is that the integrated microfinance framework that Professor Merton showed us is a very powerful tool, and it has many implications for policymakers, of course. I really want to thank you, Professor, for sharing your time and knowledge with us. I think it's very much appreciated by our community. Thank you. And with this, I pass the mic to Flor's team.
Thank you.
Thank you. Not every day we have the opportunity to interact directly with a Nobel laureate. Professor Merton and Juan Carlos, thank you very much for taking the time with us. It has been really fascinating. I must extend our gratitude to Dimensional and in particular to Jessica Walton, who has been with us coordinating this session for more than a year. Keeping alive our Cartagena conference traditions, tomorrow's session will be reserved for officials from central banks and public institutions only. If you have not yet received your invitation by tomorrow morning, we apologize in advance. Please contact us and we will be happy to provide you or your team members with access to the session. Iker Subizarreta, our Chief Financial Officer, has set up a panel with the virtual presence of Carlos Bernardel from the ECB, Jaime Cortina from the BIS, Fabio Malacrida from the Central Bank of Uruguay, and Jorge Patron from the Central Bank of Peru. They will be discussing the implications of COVID-19 shock from their perspectives. To our wider audience, thank you for your precious time and attention during the 7 episodes of our Cartagena Talks that ends up with this conference. From FLAR, we wish you a happy holiday season and preserve the spirit of our Cartagena gathering. We will try to keep innovating in 2021. Thank you.
Thank you. Thank you, Juan Carlos.
Thank you, Professor Merton. It was a pleasure.
Okay.
Thank you very much.
So, okay, thank you all. I'm sorry about the technical mess up. I don't know how it happened.